Assalamualaikum and good day to each and everyone. In this video, we are going to tackle about Module 11, Financial Intermediaries and Risk. So first and foremost, let me give you an overview of the whole discussion. First, we are going to tackle about the common characteristics of financial intermediaries, then the types of risk faced by financial intermediaries, and lastly, an elaborated discussion about commercial banking. So hello everyone, I am Salma B, Abdullah, and I am here to present the common characteristics of financial intermediaries. Deeper into our main topic, let me give you first an overview of the three major players in the financing world. So first is the household. So household is seen as the supplier of capital. Why do I say so? So basically, household earns money with their salaries. And in those salary, let's say you have 50,000 pesos and 30,000 of it may be used in daily expenses such as foods, transportations, and lahat ng gastusin sa bahay. And 5,000 of it may be spent in luxuries and wants. So the remaining 15,000 you might either deposit it in the bank or invest it for future purposes. And the banks or where you invest your money will lend your money out. And so purchasing securities issued by the firms, you are simply called the supplier of capital. So the second one is the firms. So if you, the household, is a supplier of money, firms are the demanders of capital. That is, they need money to expand, to purchase property, plant, and equipment. And then by purchasing properties, the firms will generate income. And some of its portion will be returned back to the household. And that is, the income generated by those real assets provides the returns to investors who purchase the securities that is issued by the firm. And lastly, we have the government. Government may act as a lender and a borrower. Nagiging lender si government whenever the tax revenue is greater than the government expenditure. Likewise, nagiging borrower naman siya when the government expenditures exceeds the tax revenue na nalikom ng government. And they borrow money by issuing bonds, securities such as T-bills. So now that we know the relationship between the three major players in the financing world, let's now talk about financial intermediaries. So basically, meron tayong dalawang agent na pinag-uusapan rito, the surplus and deficit agent. The surplus agent, yan sila yung may maraming pera or excess money na kayang i-lend. Whereas the deficit agent, yan yung kinukulang sa pera or someone in need, and it may be individual or company. So when we talk about intermediate, that's something na nasa gitna. That's something in between. So financial intermediary is somewhat in between these two agents and basically connects these two agents, and it acts as a middleman. Financial intermediary is nag-channel ito from the surplus to the deficit because most practically, these two agents do not know each other. Okay na sana if personal na utang lang. But in most cases, in business setting, di yan magkakakilala yung mga agent na yan. Kaya nga, there is financial intermediary that links the two. So, that is surplus being the lenders and deficit being the borrowers. Si lender, magbibigay yan ng fund kay bank, tapos si borrower pupunta kay financial intermediary or bank to get some money that he needs. So there are three functions of financial intermediaries. First one is the maturity transformation. Basically, there are times wherein these two, the surplus and the deficit, does not meet the same needs. Sometimes si surplus gusto niya is long term, pero si deficit gusto naman niya is short term. So di sila nagmi-meet ng needs. So what will happen is that financial intermediaries will adjust to cater the needs of the two. The second one is the risk transformation. So si surplus, kapag nagpautang yan sa iisang tao lamang, mas risky yan. Just like the concept of risk and return. So, basically, mas risky talaga kapag nag-invest ka lang sa stand-alone investment kaysa sa mag-invest ka in multiple investments or the portfolio. So, what happens is that through financial intermediaries, pwede niyang ipautang yung pera to different deficient agent. So, or different borrowers. So, therefore, medyo nalilesen yung risk or nasa-spread yung risk through financial intermediaries. So, the third one is the convenience denomination. So, ganun din sa amount, aside from maturity terms. Yung amount nila does not match normally for example, ang gi-invest ni surplus is 50,000 at ang hinihingi naman ni deficit is 10,000 lang. So, pwede ngayon na si financial intermediary i-distribute yung 50,000. So, for example naman is if si borrower is need niya ng 500,000 pesos and we have different surplus and sum up for 500,000 pesos. So, bahala na yan si financial intermediaries and siya yung magmamatch ng kanilang needs depending kung ano yung mga kailangan nila. So basically, we have two types of financial intermediary, the depository type and the non-depository type. Depository type is that the financial intermediary that accepts deposit, while the non-depository type is the opposite one. So, example of depository financial intermediary is the commercial bank, wherein halos lahat ng banking services is nandito na. So, an example of it is or BDO here in the Philippines. So, the second one is the thrift institution, wherein yan yung mga savings bank, loans association, mutual saving, and na nakafocus sila sa pagpupul ng savings ng mga tao. And prominent example for this is the BPI savings and the China Bank savings. One is the credit union, wherein it is a small non-profit depository institution in which yung member niya is also its customer. So, the difference between credit union and bank is that credit union is a non-for-profit in structure, while bank is for-profit. And basically, ang major difference nila is that credit union is naka-base lang yan sa local and maliit lang or limited lang yung offerings nito. While bank is typically national, where it has a wide variety of service. So, the next one is the non-depository or contractual savings institution. Pinakauna na dito si insurance company, where it has two types. So, ang system ng non-depository is that yung mga surplus natin, binibigay natin kay financial intermediary, and then financial intermediary would invest yung surplus natin doon sa capital market, just like bonds and stock. So, insurance company, yung tao, yung nagpapa-insure sa company. And si company naman, ini-invest niya yung pera into different portfolios para lumago ito. So, doon na-channel yung fund from the insured or yung kumukuha ng insurance policy and the investments. So, life insurance and casualty insurance difference is normally kapag si insured is namatay in life insurance, the family would claim certain amount of money sa insurance company, wherein casualties naman is just like an accident insurance or yung mga bagyo or sunog or mga casualties. So, basically, same lang yung ginagawa pero iba yung situation na kailangang ma-achieve. So, insurance premium is what being paid by the insured and ini-invest ito ni company. So, in pension fund naman it's for retirement. So, si employee nagbibigay yan ng pera sa pension fund, tapos yung pension fund naman pinapalago niya yung pera. Ini-invest niya yung pera sa companies to stocks or bonds. So, the pension fund is medyo long-term yung arrangement and makukuha mo lang siya through retirement. So another type of financial intermediary is the investment fund. And a prominent example of it is mutual fund. So kung si insurance company is naka-claim niya yung pera niya, a certain situation happens and pension fund is nakukuha niya yung pera niya through retirement. In mutual fund naman, it is a form of investment wherein si lender magbibigay siya ng pera sa mutual fund just like stock. But in mutual fund, ang tawag natin dito is units since it cannot issue stock because it's not a corporation. So, in mutual fund, there is a fund manager wherein it is an expert in financial analyzing. So, the fund manager basically invests those money to different portfolios para lumago ito and maka-return back sila sa investment ng lenders. So up next for this is the type of risk faced by financial intermediaries. So that's all for my report and thank you.
So Assalamualaikum and good morning everyone. I am Hafsah A, DISOMANGCOP, and I will be discussing to you some of the types of risks faced by financial intermediaries. So before I proceed to the types of risks faced by financial intermediaries, so first let me define what is risk. So risk is inherent in any business enterprise, and a good risk management is an essential aspect of running a successful business. So a company's management has varying levels of control in regard to risk. So some risks can be directly managed. Other risks are largely beyond the control of the company management. Sometimes the best a company can do is to try to anticipate the possible risks, assess the potential impact on the company's business, and be prepared with a plan to react to adverse events. So here are the types of risks faced by financial intermediaries. So yung first type of risks faced by financial intermediaries is yung interest rate risk. So interest rate risk is the potential for investment losses from a change in interest rates. So basically, if yung interest rates natin ay mag-rise or increase, for instance, then yung value of bond natin will decrease and vice versa. So ibig sabihin that the market price of existing bonds drops to offset the more attractive rates of new bond issues. So yung pagbabago ng ating interest rates can affect many investments, but it impacts the value of bonds and other fixed income securities most directly. So yung mga bondholder, they carefully monitor yung interest rates and they make decisions based on how interest rates are perceived to change over time. So an example ng interest rate risk is, let's say, an investor buys a 5-year, $500 bond with a 3% coupon. So let's say yung interest rate rises to 4%. So yung investor na yon ay mahihirapan siyang ibenta yung bond na yon when your bond offerings with more attractive rates enter the market. So the lower demand also triggers lower prices on the second market. the market value of the bond may drop below its original purchase price. So yung pangalawang type of risks faced by financial intermediaries is yung foreign exchange risk. So yung foreign exchange risk refers to the losses that an international financial transaction may incur due to currency fluctuation. So this is also known as the currency risk, FX risk, and exchange rate risk. So this is where it describes the possibility that an investment's value may decrease due to changes in the relative value of the involved currencies. So itong foreign exchange risk ay naapektuhan din niya yung mga investors aside doon sa mga financial intermediaries who trade in international markets and business engaged in the import or export of products or services to multiple countries. So actually, may three types of foreign exchange. Merong a transaction, translation, at saka economic risks. So example ng foreign exchange risk, let's say, ay mayroon isang American liquor company and nag-sign sila ng isang kontrata kung saan bibilhin nila yung 100 cases of wine from a French retailer for 50 euro per case or 5,000 euro in total with payment due at the time of delivery. So, nag-agree yung American liquor company na yon sa kontrata na yung during nung time na yon, yung value pa nung 1 euro is $1. So, ini-expect nung American company na yon na ang mababayaran lang nila is yung 5,000 euro. Since nung time na nag-agree sila is $5,000 din yung equivalent. Pero, di ba, it will take times pa bago ma-deliver yung wine since galing pa yung sa ibang bansa. And in the meantime, due to the unforeseen circumstances, yung value ng US dollar depreciates. Kumbaga, bumaba siya compared doon sa euro. Where nung time na na-deliver na yung wine is 1 euro is equivalent na to $1.10. So yes, yung contracted price is still 5,000 euro, but yung equivalent na nun in dollar is 5,500, which is the amount that the American liquor company will have to pay. So yung pangatlong type of risks faced by financial intermediaries is yung market risk or yung price risks. So this is the possibility that an individual or other entity will experience losses due to factors that affect the overall performance of investments in the financial markets. So yung market risk is pwede siyang mag-occur due to the changes of interest rates, na-mention ko na yan kanina, exchange rates, geopolitical events, or recessions. So yung pang-apat na type of risk faced by financial intermediaries is we have the credit risk. So credit risk is the possibility of a loss resulting from a borrower's failure to repay a loan or meet contractual obligations. So traditionally, yung credit risk is yan yung mga risks that lender may not receive the owed principal and interest, which results in an interruption of cash flows and increased costs for collection. So excess cash flows may be written to provide additional cover for credit risks. So when a lender faces heightened credit risk, it can be mitigated via a higher coupon rate, which provides for greater cash flows. So kapag yung nagpapautang is nag-offer ng mortgages, credit cards, or other types of loans, so merong risk that si borrower may not repay the loan. So similarly, if a company offers credit to a customer, so merong risk that the customer may not pay their invoices. So credit risk also describes the risk that a bond issuer may fail to make payment when requested or that an insurance company will unable to pay a claim. So yung credit risks are calculated based on the borrower's overall ability to repay a loan according to its original terms. So yung panglimang type of risks faced by financial intermediaries is yung liquidity risk. So liquidity risk is the ability of a firm, company, or even an individual to pay its debts without suffering catastrophic losses. So conversely, liquidity risk stems from the lack of marketability of an investment that can't be bought or sold quickly enough to prevent or minimize a loss. So it is typically reflected in unusually wide bid-ask spreads or large price movements. So basically, if yung mga individual investor, businesses, or yung mga financial institution cannot meet its short-term debt obligations, so it means they are experiencing liquidity risk. So an example of liquidity risk, let's say yung $500 home might not have no buyers when the real estate market is down, but the home might sell above its listed price when the market improves. So the owner might sell the home for less and lose money in the transaction if they need cash quickly. So must sell while the market is down. So investors should consider whether they can convert their short-term debt obligation into cash before investing in long-term liquid assets to hedge against liquidity risk. So that's all for my part, and the rest types of risks faced by financial intermediaries will be discussed by one of my groupmates. That's all. Thank you.
Assalamualaikum and good day everyone. I am Omaima, AMBACO, the third reporter. So this is actually a continuation video about the risks that are faced by financial intermediaries. So without further ado, let's get started. Among the risks that are faced by financial intermediaries is this off-balance sheet risk, or also known as the OBS risk. So it is defined as a risk faced by financial institutions because of its contingent asset and contingent liabilities as well as OBS financing. So to explain this further, let us move to the next slide. So the term off-balance sheet financing refers to an accounting practice that involves recording corporate assets or liabilities in such a way that doesn't make them appear on a company's balance sheet. So these off-balance sheet items are often difficult to identify or mahirap talaga siyang matrack sa financial statement ng isang company kasi nga hindi siya nilalagay or hindi siya nag-a-appear specifically sa financial position ng isang company because they often appear in the accompanying notes. So although they may not be present on the balance sheet, they still belong to the business. And so they are still part of a business assets and liabilities. So dahil nga importante sa mga investors yung mga financial statement ng isang company in order to assist a company's financial health, nakakatulong itong OBS financing sa mga companies, especially those companies na mga baon sa utang. So yun nga, a healthier looking balance sheet is likely to attract more investors. And in order to meet these goals, companies may need to turn to certain accounting strategies like this off-balance sheet financing. So now let's move on to the technology risk, which is simply defined as the risk that technology will not work according to how it was designed or technology failures disrupt the financial institution's operations such as a system malfunction or information security breach. So we're all aware naman with the fact na these risks are becoming common or prevalent since almost everything now is being improved and are shifted to various online platforms. So nag-increase yung risk na i-encounter natin due to the fact na most of the company's operations now uses technologies. So what actually are these technological risks? So there are many types of technology risk and here are some of those. Companies may face information security incidents such as cyber attacks, password theft, service outages, and many more. So every type of technology risk has the potential to cause financial, reputational, regulatory, or strategical risk if an appropriate incident response is not implemented. So as a result, having an effective technology risk management strategy in place to anticipate political problems is essential. So another risk is what we call the operational risk. These are risks that arise from carrying out daily operations. Examples include the risk of losses due to insufficient management of breakdown from internal procedures, employee issues, system issues, and a variety of other issues. So operational risk can be caused by a variety of circumstances, including employee mistakes, criminal activities like fraud, natural disasters, worldwide health crises, and man-made disasters. It is crucial to evaluate and to have a proper management in eliminating this risk, since this could truly have an unfavorable impact to a financial institution and in order to at least ensure successful responses. So this would cause a huge problem if left unaddressed due to the reason that this can cause monetary loss, competitive disadvantage, employee or customer related problems, and worst, business failure. So the next risk is the country or the sovereign risk, which basically reflects how a government can affect the financial system of its country. So country risk refers to the risk of making investments in a certain nation and the level of uncertainty that could lead to monetary loss. Investors should take a number of aspects into account when evaluating this kind of risk, such as the overall stability, the political and economic climate, and the currency. Moreover, sovereign risk determines the possibility of a government missing its financial obligations, for example, default risk of sovereign bonds. So in accounting, it is widely known that the company is insolvent when obligations exceed assets, due to the complexity of financial systems and the crucial function that financial institutions play within them. Hence, this insolvency risk is the risk that the financial institutions won't be able to pay off its debts, will have negative equity, or won't have enough assets to cover its liabilities. So to protect the public, regulation of them is just to be expected. A nation cannot afford for its financial institution to fail, as this would eventually result in the collapse of the financial markets in the entire financial system. So I guess that would be all for my topic. A detailed overview regarding commercial banks is included in the next video.
Assalamualaikum warahmatullahi wabarakatuh. Good day everyone. I am Princess Raihana DEROGONGAN and I am assigned to discuss to you guys what is commercial banking. Specifically, what is commercial banks, its characteristics, and its advantages and disadvantages. Now, what is a commercial bank? A commercial bank is a for-profit financial institution that accepts deposits, offers loans, and provides other financial services to its customers. Commercial banks help fulfill the medium and short-term financial requirements of businesses. They do not provide long-term credit since they need to maintain the liquidity of their assets. Now, what are the characteristics of a commercial bank? There are only two characteristics of a commercial bank, namely borrowing and lending. Now, the bank receives the deposits and gives money to various projects to earn interest. The rate of interest that a bank offers to the depositors is known as borrowing rate, while the rate at which a bank lends money is known as the lending rate. Now, what is the disadvantages of a commercial bank? First, savings. The operations of commercial banks encourages savings, although money saved in banks are not regarded as investments, but then it yields some interest to savings, fixed deposits, and other forms of savings account holders. They therefore encourages capital accumulations, which helps to scale up economic advancement. Number two, safekeeping of public wealth. Keeping money at home in this modern time will lead to a high rate of theft and robbery. Therefore, it is much safe to deposit it in commercial banks instead. Number three is provisions of loans. Raising capital through bank loan is easier than raising capital at the capital market. which has a long protocol, high qualification requirements, and high cost of raising capital. Number 4 is financial prudence advice. They give financial, technical, and management advice to their customers in matter relating to investment. Number 5 is facilitation of business. Transactions and payments, traders, and individuals who handle plenty money find it easier and safer to carry a large amount of money in the form of checks, bank drafts, ATM cards, online wallet from one place to another. The money lost by businessmen and investors thereby reduced. In this present modern economy, commercial banks make the transactions possible by providing digital payments technological platforms available. Now, number 6 is facilitation of global trade. They facilitate international trade and travel by making foreign exchange transactions easier. Number 7 is reference. Banks act as references as to the integrity and financial standing of their customer. Now, number 8 and the last is conversion of digital currency. People who hold digital assets may wish to convert their digital assets to fiat currencies. Commercial banks facilitate the transfer and conversion. Now let's move to the disadvantages of commercial banks. First is leakages. There may be some leakages in the bank system which may be caused by bloated costs by the bank's management, bank staff tampering with customers' deposits, bad loans, and etc. Number 2 is risk of robbery and fraud. Piling up cash in publicly known places like banks can attract robbers. The increase in internet banking in recent times has as well led to increase in cybercrime. Number 3 is bankruptcy. Mismanagement of the depositors' and shareholders' funds by the bank's management can lead to commercial banks going bankrupt. Global or regional economic recession and or depression where economic activities were negatively impacted can lead to customers doing more of withdrawal transactions than depositors, and also making the borrowers unable to meet up with their loan repayment obligations. Banks may not have enough cash to meet up with withdrawals demands. Now, lastly is encumbrance process of getting loans. If people do not have the necessary collateral securities with which to borrow money from the banks will be reluctant to make loans available. This therefore tends to hamper the ability to create money. Now, that's all, and thank you for listening. Again, I am Princess Raihana and stay tuned for the next reporter for the functions and types of commercial banks.
Assalamualaikum warahmatullahi wabarakatuh and good day to all of you. I am Sittie Islah HADJI FAISAL and today I'm going to continue our foregoing discussion, and the topic assigned to me is the type of commercial bank and the function of commercial bank. So without further much ado, let's get started. Commercial banks fall into three main types, and they are public sector banks, private sector banks, and foreign bank. Public sector banks. These types of bank have been nationalized by a country's government. The major stockholder is the government. In most cases, these banks operate under the country's central bank. So, in short, public sector bank is a financial institution in which the state, municipality, or public sectors are the owner. So, these banks is under the control of the government. Basically, more than 50% of the shareholding lies with the central or state government. So, an example of public sector bank that operate here in the Philippines are the Land Bank of the Philippines, Philippine National Bank or PNB, Bank of the Philippine Island or BPI, BDO Unibank, and more. So other type of commercial bank is the private sector bank. So it is a type of commercial bank where private individual and businesses own a majority of the share capital. So if in public sector bank, it is under the government control. In private bank, in contrast, it is under the control of a private individual as a major share capitals lies with the individual and private businesses. As such, they are limited liability company. So there are many private bank operate here in our country, such as BDO Private Banking Corporation, Robinson Bank Corporation, and the Philippine Veterans Bank, the Bank of Tokyo, Mitsubishi, and etc. So lastly, we have foreign bank. Foreign bank, from the name itself, foreign. It is a bank with a headquarters in a foreign country and branches in different parts of the world. So in simplest term, it is a bank which is owned by a foreign investor. Although it is controllable by a foreign country, it is still obligated to follow the rules and regulation of both home and host country. So foreign bank plays a great role in helping support the economic standing of that country apart from serving the financial needs of its people. So here in the Philippines, there are 29 foreign banks including the Bangkok Bank Public, City Bank, and the Bank of China and more. Now, the question is, how does commercial banking function or work? So, in the next slide, we will be discussing about the function of the commercial bank. The function of commercial bank are categorized into two. So, first is the primary function and second is the secondary function. So, in primary function, it includes the accept deposit and grant loans and advances, while in secondary function, it includes the utility function and the agency function. So one of the primary function of commercial bank is accept deposit. So basically, the bank's main function is to accept deposit from the customer and uses those deposits to make loan. So the bank accept deposit in the form of demand deposit, time deposit, and fixed deposit. So when we say demand deposit, it includes the saving deposit and current deposit. So we already know that demand deposit is a bank account that can be withdrawn on demand anytime. While time deposit, in contrast, is an account that cannot be withdrawn before a set date. So time deposit is interest bearing. On the other hand, fixed deposit is a deposit that can be received for a fixed period and it provides a higher interest rate than a regular saving bank. Another critical function of commercial bank is to offer loan and advances to the customer. With this, the bank can gain a profit through interest income. So like what I mentioned earlier, commercial bank accept deposit and the deposit that they have accept is what they use to make a loan. So in short, depositing or lending is the two pillars on which the structure of bank is present. Now, the loan offered by the commercial bank can either be a short-term loan which will be matured less than a year or a long-term loan which will be matured more than 1 year. So aside from loan, the commercial bank also offers advances. So advance is a credit facility provided by the bank to their customer. So advances is differ from loan in a sense that advance can only be offered in a short period of time. Moving on to the secondary function of commercial bank. So the secondary function of commercial bank included the utility function. So a commercial bank performs utility function for the benefits of its client. So the utility function included the locker facility. So commercial bank provide a locker to keep valuable articles of the customer in a safe custody. Second, the commercial bank issued a traveler check to their customer to avoid risk of taking cash during their travels. A letter of credit. It is an important method of payment in an international trade. The commercial bank also issue a draft and check. So draft and check is an order to pay money from one branch of a bank to another branch of the same bank or the other bank. The project report. So the bank also undertake to prepare project report and feasibility studies on behalf of their customer. Third, gift check. So the bank also provide a gift check to account holder as well as to the non-account holder. Underwriting security. The commercial bank also undertake the task of underwriting security. And lastly is the gold-related security. So, commercial banks are buying and selling gold or gold ornament from customer on a large-scale basis. The last secondary function of commercial bank is the agency function. Commercial bank act as the agent of customer by performing various functions. So, first is it helps the client in collecting and paying checks, dividend, interest warrant, and bill of exchange. It also helps the customer in paying the insurance premium, utility bills, rent, and other charges on behalf of their client. Second, bank provide the facility of economical and easy remittance or transfer of funds from place to place. Third, they assess and help their customer in foreign transaction. Fourth, commercial banks buy and sell security such as shares, bonds, debentures, and etc. on behalf of their customer. Commercial bank also gives advice to their customer on matters regarding the income tax return. Commercial bank also act as a trustee and executor. And lastly, commercial bank provide economic information to their customer. I think that would be all, and thank you and wassalam.